Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you. Hey guys, welcome back to Be Rich. As promised, we're back to the second part of the video where we discuss 5 reasons why gold may not make much sense to hold on to. So let's get right into it. The first reason why is what Uncle Warren has talked about before, which is that gold is not a productive asset. What he means to say is that gold does not give you a dividend yield. It doesn't give you any sort of interest. It's just something that sits there and other people are willing to pay more for it. And that's why the capital appreciation is something which we see in gold. There is no actual yield or any sort of return which we can see in gold in that regard. So on that basis, gold is not something which is preferable to invest most of your money into, or even a large sum of your money into. It's only preferable to hold a small portion of your portfolio
as a hedge
in gold. So do you have any comments to add on this?
This is absolutely true.
Yeah.
Especially if you're looking to generate huge amounts of wealth. You're not going to generate huge amounts of wealth by buying gold. Meaning you can buy gold at the age of maybe when you're 10 years old, and then when you're 80 years old, yes, you can argue it's become huge. But at the same time, if you had been trading in the stock market during that period of time, buying shares at value and holding them for 15-20 years, you would have done far better. And we have done videos of this before, where considering the gold growth graph compared to the S&P 500 or the Nifty 50 or the Sensex, showing how we have not performed, gold has not performed like how it has compared to this.
Yeah.
But the problem lies, the reason why we buy gold is also because we don't want to do the hard work of knowing what's happening in the market, knowing about companies, knowing about shares, and be willing to take a risk. The 2 reasons why people buy gold and stay stuck to gold is, one, they have a huge risk aversion. And the reason why they have a risk aversion is because of lack of knowledge. When you're scared of the dark, everything looks scary and like there's monsters. The best way to dispel darkness is through knowledge and enlightening yourself, and that will dispel all fears. So, holding on to gold more than 5% is not advisable, like Warren said. I agree.
Yeah. And that brings us to a second point, which you already highlighted, which is that there are other asset classes which tend to perform better than gold. So, you might have seen the last video on how gold does better than stocks during recessions and how it does better when there's times of inflation. It's a great hedge. All that's fine. But then why are you now suddenly telling me that there are other asset classes which perform better than gold? Well, the reason I'm telling you that is because there's one key phase which I didn't talk about, which is that a bull run phase, when the market decides to go up. When the market decides to go up, stocks end up doing generally much better than gold does, because gold is very much linked to reality, whereas stocks can be pushed as much as they need to be. And especially in stocks, there's another component, which is the fact that earnings also go up with inflation, and the amount people are willing to pay for the earnings also goes up during good period. So you tend to have a double whammy effect on stocks. And there's also a bias towards bull runs rather than a bear market, because there are lower circuits attached, and then there's the Federal Reserve or RBI, many intervention bodies willing to intervene when things go awry. But when things are great, no one is complaining. The Federal Reserve or the RBI aren't too willing or too keen to pull the plug on a party. Jerome Powell was someone who was able to do it. But generally speaking, Federal Reserve governors as well as RBI governors are quite scared of trying to pull the plug on a party, because it's a political move which will lead to political suicide for the government in place at that time, because the government will then be blamed for what was happening in the market. Whether they are to be blamed or not is a different story, but they will be. So this is the point. So when bull runs occur, and they do occur for a long time, stocks have greater runway and they have more potential to take off compared to gold.
Bull runs have always been longer compared to bears.
Yeah.
There's no doubt about it.
At least before, when the Federal Reserve was not allowed to print as much as they wanted to, that wasn't the case. I mean, yes, bull runs were still longer, but there was a sort of check and balance to how long a bull run.
The frequency of change was much higher.
Yeah, frequency of change was much higher.
Steam wasn't allowed to build up in the chamber so much.
Yeah, but today there's
no release valve.
Yeah, there's no release valve unless you have a Federal Reserve governor who decides to walk in and step in and say, let's pull the plug on the party a little bit. It's gotten too much. Okay, that being said, second point is done when gold underperforms certain assets in the long run, like stocks. So the third point, gold is expensive to hold in great amount of quantities.
You have store.
That is store, yeah. For you to be able to hold gold in terms of a locker, that means you need to pay for a bank locker. I'm not sure, do you have to pay a yearly fee for it?
Yes, annual fees, the locker fees.
Annual locker fee. And the more gold you have, the more lockers you need to take up.
Correct.
So that is something which is probably going to be a cost. And even if you don't want to store it in a bank and you want to store it at home, I mean, I don't know whether I'd be comfortable holding a locker at home with a ton of gold.
Even in the bank locker, there's no safety.
Yeah, there's no safety. So
and insurance only covers you so much.
Yeah, and insurance only covers you so much. So the point we're trying to make here is that, yes, storage costs and the risk of theft ends up going up when it comes to
gold. Of course, our commenters will immediately jump in and say, no, but you can hold it as ETF. You can hold it as bonds.
But you can't take on gold loans on that. The ability which gold lends you, in the sense that you can leave the country and borrow elsewhere, or you can immediately take some gold without questions asked, you'll get some money for it. That's not something you can do with ETFs. Again, then you've gone into paper
Correct.
gold, which you have to deal with all the problems papers bring with it. So that's another point. Next point. Gold is subject to a lot of volatility. We talked about this in the last video, that you have to hold it for the long run, you said. And I can't agree more. Because gold is something which is very, very volatile in the short run. Because if you look at gold from the period of 2012 to 2015, 2016, gold actually performed quite poorly in the US. In India, it's a different case because our currency is constantly depreciating.
Correct.
But if you look at gold in the US, it did underperform during that period. And it underperformed by quite a bit. It underperformed the market by quite a bit. And from the period of 2012 to almost up to 2020, after which the COVID recession happened and gold prices went up after that. But before that point, gold did not perform quite well. It flatlined. It went up by very little bit. And this is something which...
That was the time when people were arguing saying gold is dead.
Yeah. So the point we're trying to bring out here is the fact that if you look at it in the short run during different phases, gold has underperformed in a lot of phases. But if you look at the graph for the past 20 years, gold has performed quite well. So this is another point. What do you have to say about the volatility?
Yes. So if you're planning to keep gold for a very short period of time, short period means 5 years less, I would suggest not to really buy gold.
Yeah.
If you're willing to hold it for longer than 5 years, then it's worthwhile holding gold. Because most of the volatility will be negated if it's more than 5 years.
And finally, the major point that today affects gold and something which will continue to affect gold is the fact that gold is something which can be manipulated in the macroeconomic scale. Like when China decides to absorb gold from the market, you are going to feel that as someone who holds gold. Yes, this has been a positive development, but tomorrow China may decide to dump gold. And if China decides to dump gold, that means the price of your gold is going to go down.
Yes.
And no one can go and stand up to Xi Jinping and tell him, please don't manipulate gold. Even the US cannot. And
when he decides to do it, why he decides to, no one knows.
No one can predict it unless you are a soothsayer and a very successful one at that. Then kudos to you. You don't need to watch this video. But apart from those kind of people, the people who are like us, who can't tell the future, who just want to hold gold as a hedge in their portfolio, for us, we can't predict the future. And when you can't predict the future, you have to accept the fact that when gold is being manipulated, there's nothing you can do but sit down and hope that this passes, and it will pass. And when it passes, you generally see the price correct to the level which it should be.
But how long will it take? We can't say.
We can't say, and we genuinely can't predict when it will happen or if it will happen. So this is something you have to accept as a risk when someone is owning gold. So these have been 5 reasons why you should maybe not have most of your money in gold. And we discussed 5 reasons why you should have some of your money in gold in the last video. And we hope this has given most beginner investors a nice recap of why and what gold does and why an investor may consider gold and may not consider gold. Do you have any final comments?
Yes. So what you learn from both these videos is diversify. Have a bit of gold, not too much. Have a bit of stock, not too much. Have a bit of bonds, not too much. Don't be sitting in one specific spot. Keep your, what you call, base spread, as they say. So that way your risk is spread and you lighten your load. And that way when your asset classes are not doing so great, you will see recovery in another asset class, which will lift your spirits. Most of this is psychology, because across the board, if you see most asset classes over a period of 10, 15 years, tend to do okay. They tend to perform. Performance may be difference in percentage points, but they all tend to perform. But this reason why we say keep spread is because the simple reason is it will help you psychologically to keep investing, to keep moving forward. Even when you see downturns in the bond market, downturns in the gold market, downturns in any other thing, you'll see an uptrend in something else. All these cycles don't run in sync. They all run independently of each other, and some are vice versa to each other. So that's why I say keep yourself diversified.
Right. So that being said, we hope those of you at home enjoyed these two videos, and we will continue to make these videos in a series on why certain asset classes are to be held, or maybe why you should consider holding other asset classes. And that being said, thank you for watching this video. If you liked it, please hit the like button. Please subscribe if you haven't already. Hit the bell icon to get notified of when we upload our new video. And finally, if you have any comments or opinions you'd like to express on gold or otherwise, please leave them in the comment section below. We are happy to read what you have to say. Thank you again for joining us on Be Rich.
Thank you.
I told you about visiting Singapore. The date has been finalized. It's 25th August. It's a Sunday. Those desirous of meeting me in Singapore can drop a message to the WhatsApp number given below or contact my team by an email. My team would reach out to you and we will assure you of our best services. For English and Hindi, there will be a separate PT. See you in Singapore. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.